Good morning and good afternoon, everyone. Welcome to this roundtable discussion on what can the public and private sector do to turn transition finance framework to actions. My name is Ma Jun. I chair the Green Finance Committee of China Society for Finance and Banking, which was set up by the PBOC 7 years ago. I'm also involved in many international initiatives, including by co-chairing the G20 Sustainable Finance Working Group, co-chairing the IPSF Working Group on Common Ground Taxonomy, and co-chairing the NGFS Inspire Study Group on Biodiversity. Let me start by thanking the organizers, including BIS, ECB, NGFS, and PBOC for co-organizing this Green Swan Conference. It's my great honor and pleasure to have this opportunity to moderate this roundtable discussion on the very important topic of transition finance. Let me begin by introducing our 7 distinguished speakers who are joining this discussion today. Madam Masita Kristalling, who is a special advisor to Indonesia's Minister of Finance on macroeconomic and fiscal policy. Professor Nick Stern, who is professor of economics and government and chair of the Grandson Research Institute at London School of Economics. Daniel Hanna, global head of sustainable finance at Standard Chartered Bank. Paulina Dimek-Hack, director of general affairs, DG FISMA, European Commission. Sue Lord, Vice Chair of International Sustainability Standard Board. And we have Karen Kam from Deutsche Bank. He's the Managing Director of Head of ESG for Asia. And last but not least, Vivek Passa, who is the Director and Global Head of Climate Business from the IFSC. Most of today's speakers are my old friends, and they are opinion leaders, policymakers, and or practitioners in the sustainable finance space. They represent a wide range of perspectives, including from government, the private sector, MDB, standard setting body, and academics. I think we will have a very fruitful discussion. Turning back to the topic today, which is financing climate transition or transition finance. As many of you have noted, green and sustainable finance has developed rapidly in the past few years. However, the green and sustainable finance market as of today still focuses largely on financing pure green economic activities, such as renewables and electric vehicles. A much larger part of the economy, which is carbon intensive today, but it has a potential to decarbonize and move towards net zero, does not get financed properly in the current version of the sustainable finance market. The G20 has recognized this problem, and in its G20 Sustainable Finance Roadmap, which was issued last year, we stated that we should establish a transition finance framework to help mobilize more private capital to support a just and affordable climate transition. Indeed, it has become a major task of the G20 Sustainable Finance Working Group this year under the Indonesian G20 presidency. Within this G20 working group, a broad consensus has been reached that this framework should include 5 key elements. Number 1, identification of transition activities, namely providing clarity on the eligibility criteria for transition activities and thereby preventing transition washing. There are a couple of different approaches to identify qualified transition activities. One of them is called the transition taxonomy, which is actually contained in the EU taxonomy and is being developed in China. The other approach is called principle-based approach that's being proposed by Japan. The second element of the transition finance framework is reporting of transition activities, which should include the reporting or disclosure of information related to the company's transition plan, science-based emission reduction targets, carbon emission data, as well as implementation of the transition plan. And the third element of the framework is financial instruments, which currently include debt instruments such as sustainability-linked loans and bonds, but other instruments, including equity and de-risking tools, are also important. And the fourth element of the framework is policy incentives, which should support transition and to make more of these transition activities bankable. And the final element is to incorporate the just element into transition finance. Some of the transition activities may have negative social impact. For example, they could lead to unemployment in a particular region. So we're hoping that in the design of the transition finance framework, we can find ways to encourage companies in transition to assess and address these social impacts. With this G20 discussion as a backdrop, let me now turn to our panelists and hear their views on how private and public sectors can work together to develop transition finance in order to mobilize adequate financing to support the transition of carbon-intensive sectors, companies, and assets towards net zero. I will ask each panelist 2 questions, and please try to keep your answer to each of these questions at around 3 to 4 minutes, no more than 5. So after the first round, we may still have some time for the second round discussion. Let me start with Madam Kristalin from Indonesian Minister of Finance. As the G20 presidency in this year, what are your views on and expectations for the transition finance framework, which is being developed by the G20 Sustainable Finance Working Group? And as a large developing country, what is Indonesia doing or thinking about doing in the area of financing climate transition? Madam Kristalin, floor is yours.
Thank you, Majun. So as you explained that this year in the Sustainable Finance Working Group, Indonesia has created a framework for transition finance, which include the 5 elements that you mentioned. Of course, the aim is to support a whole economy transition towards lower and net zero emission, which align with the Paris Agreement and 2030 agenda. But also we have to make sure that the pathway or the transition will be just and affordable not just for in the project level, in the corporate level, but also in the budget level, for a country to afford the transition. One of the policy agenda that you mentioned is very critical for Indonesia, emerging market, big economies, and the world. And we're thinking of developing, an orderly transition and develop a comprehensive and also practical framework. You have mentioned that there will be local context and there will be principle or taxonomy based. There are pluses and minus for this, and of course, we are discussing this inside the working group. We also recognize that the framework should enable the provision of credible transition and also address the concern of transition washing or greenwashing, and thus we need to monitor the implementation. In this regard, we have to also take into account the different nature of countries. So there's a big countries, the big suppliers of carbon countries such as Indonesia, Brazil, etc. In the case of Indonesia, we don't have the demand side yet. We only have the supply side. So what type of regulation that can actually combine the different objective and different patterns of countries? Yeah, for example, Europe, an advanced economy, has already a mature demand for the carbon, and Indonesia and other emerging market is still in the transition. We also want to make sure that the transition finance is interoperable between countries. This, of course, will make it the level of development scalable into the global level. The localized negative economic and social impact is also part of the thing that we think should be a priority in talking about just transition and also transition finance. In Indonesia, we're currently working on a country platform for our energy transition mechanism. And in this country platform, we are going to use a blended financing, which includes fiscal and concessional fund as a catalytic financing in order to make a project bankable and hence can crowd in private investment. As you know, that fiscal policy alone or concessional funding alone is not possible to be able for us to afford the transition that we expect for the net zero. And of course, crowding in private investment is really important. Thank you, Majun.
Thank you very much, Madam Kristalin. Indonesia also announced earlier this year to consider developing a carbon tax to facilitate the green and low carbon transition. Can you elaborate a little bit on this carbon tax for Indonesia? And in addition, what are the policy tools Indonesia are introducing to achieve or promote the carbon reduction?
Yeah, So on top of our preparation on the country platform for energy transition mechanism, which will be launched this July, we also have developed regulation needed in order to build a carbon market and carbon pricing mechanism in Indonesia. So currently we have VCM in several areas, forestation, for example. However, we would like to be more broad-based in terms of different sectors. But we will start from the energy sectors and also forestation sectors has already started. So the carbon tax, we use 30 rupiah per kilogram or around $2 per ton. It's going to start from, will be applied initially in the coal steam power plant, the PLTU sectors. And then we are going to also create a carbon trading mechanism, which will be implemented in 2025. So now we have the presidential level regulations already out for the carbon tax. We are working on implementing regulation, and also from the carbon market mechanism and also carbon pricing side, we also already has established another presidential level regulation that's already out, and currently we're working on the implementation regulation. We use the cap and tax and trade system for our carbon tax and carbon trading. So we have a 70 and 30 division. So meaning that you can use carbon trading, yeah, to offset, but you at least have to pay 30% of your emission will be taxed by the government. So you cannot have 100%, for example, from the offset market. We have enacted the regulation, and hopefully this year all the implementing regulation will be out. Indonesia is also preparing, as I mentioned, the carbon market mechanism and carbon exchange. We're currently working on it, but we're going to do it in staging. As I mentioned, Indonesia is a big carbon supplier, so we don't have the demand side yet because we don't have the market or the regulation for the demand. There's no requirement yet. So and then if you're working in a supply side market, of course price can go down, yeah, if we don't maintain the staging and the balance between supply and demand. So we're going to do it in staging and starting with the sectors that are most contributing to our NDC, which is forestry and also energy.
Thank you very much, Madam Kristalin. I think you touch upon two very important policy instruments, carbon tax and emission trading mechanism. On the same topic, I'm going to ask Professor Nixton. There are a lot of policy choices country can consider to incentivize decarbonization, to send right signal to private sector investors for them to participate in low carbon activities. What's your view on the different policy options and policy mix in supporting the net zero transition?
Thank you very much, Marjun, and thank you for your leadership, and thank you for the organisers of the very important Green Swan for drawing us together. If I could answer that question in two parts, Marjun. The first is, as you emphasise, that this is all about investment. We do not reduce our emissions on the scale and at the urgency we need without very strong investment. And we all know, whether we read Von Hayek or Keynes or just apply our common sense, that investment is about expectations. Expectations about the ability to get it done. Expectations about the reliability of revenues and so on. So influencing those expectations in a positive and strong way is going to be extremely important. And governments can set out clear and credible plans for change. They can express it, for example, in the electricity industry with timetables for on the way to net zero electricity emissions. They can express it through the criteria for selling vehicles, for example, as in the UK, that you can't sell internal combustion engine vehicles after 2030. So those are examples of how you can influence expectations in a way that gives people the confidence to invest. The design of cities and the way in which public transport works in relation to pedestrians and cyclists will be another way of setting out strategies, pathways that influence expectations, which determine investment. The second part of what I want to say is about the multiple market failures which we have to tackle from the point of view of policy. Of course, the first one that people think of is the greenhouse gas externality, and that's why we try to correct that market failure through various kinds of price mechanisms and so on, as Masita just described. But there are 5 additional market failures which are really important. The first one is R&D, research and development. That's those ideas of public goods. We have to try to promote the creation of ideas and the sharing of ideas. And there are various policy ways you could do that, including, of course, investing in universities and so on. Secondly, there is the capital markets. We all know that capital markets do not work perfectly for all sorts of reasons of information and moral hazard of various forms and so on. So that's why we have this sort of conference around finance to try to overcome those kinds of market failures. Development banking, of course, is another way of treating that. Networks, thirdly, networks are everywhere here. Public transport, grids, broadband, recycling, and we all know that networks require government policy to be able to work properly. Next is important market failures around information. We need to know what we're buying. We need to know where it comes from. We need to know what's in it. And that will require government policy around regulation to insist on that information. Important information issues on the production side as well. And the fifth one, in addition to the first and foremost, the basic one around greenhouse gas, the fifth one is what we call co-benefits. The world kills 7, 8, 9, 10 million people a year from air pollution. In my own country, the UK, we kill 30, 35,000 a year from air pollution, most of it from burning fossil fuels. That's 20 times the deaths from road accidents. That's an immense issue. And maybe 15 or 20% of total deaths in the world. And of course, you've got the health problems in addition. So this is a very big issue. So there are 6 big market failures I've set out. Number one, and so when we start with, of course, the greenhouse gas externality, but the other 5 require government policy. It's not, do we tackle this market failure or that market failure? If we're to get the incentives right, to be able to move at the pace we need, we've got to tackle all of them. And I try to sketch, if only extremely briefly, how you might approach each one.
Thank you, Nick. This is an extremely interesting perspective of sort of framing the policy mix into a theory that lead to the conclusion that we need multiple policy instruments because we need to address many different market failures at the same time, along with this GSG externality. I do understand the few things, but I didn't sort of think that way. For example, R&D certainly is lacking, partly because of perceived risk in the market, and also a lot of information asymmetry, which prevents the right capital flows to the right activity. And it's in the ESG market as well, because we have still a lot of problem in the availability, accuracy of ESG information. And also, I think the lack of long-term financing, especially for long-term green infrastructure, is another sort of a piece of evidence of such market failure because of short-sightedness, either as a human being, judgment, or as the lack of instruments in the market. Now, let me move on to the second question for you, which is the social and economic impact of transition. As we discussed many times, the process of transitioning towards net zero certainly will involve some social cost in the form of certain companies and certain regions losing jobs and so on. And others may feel that the energy security become an issue. What's your view on how to assess these negative social impact and what should be done from public policy perspective to address and minimize these social impacts?
Thank you very much, Marjorie. This is a fundamental question. We have to change the structure of our economy, the whole world economy, all countries, all sectors, very rapidly over 20 or 30 years, and this decade being of special importance. Whole systems have to change. Energy, transport, cities, land, and it has to be fast. And we have to invest a lot, and we have to be running down some activities and running up other activities very quickly. That will involve dislocation, and we have to face it directly, and we have to try to make that transition just, because we know we're going into a much better place, but we don't want to see disproportionate costs falling on different parts of the population. It's going to be a much better world, a much better growth story that we're creating, but we don't want to damage anybody in that process. We want to try and give everybody a chance. That's the idea of the just transition. I think there are three areas where I would think about action, or three headings. The first is prices. If prices go up of carbon intensive activities, we can't give them up immediately. So there is a cost, those relative prices will rise, and there'll be some people who are hit particularly hard by that. And that is an area where we should be using our revenues in order to compensate poorer people. If we have carbon taxes, then there should be plenty of revenue to focus, as it were, support for the poorest people who are having an impact associated with on them associated with that carbon tax. So that is one set of issues around prices. There's a second set of issues around access to the new technologies. Electric vehicles, of course, need to be charged. And if you live in an apartment block in a poor area, access to charging facilities, of course, may be more difficult than if you're somebody like me and charge your electric car in your garden, in your house. And that's relatively straightforward. So access is going to be very important. Insulation is another area where access is going to be very important. Poor people generally have higher costs of capital than richer people. So the investments they need to make to switch the form of heating or cooling in their house will be disproportionately have a disproportionate impact for poorer people where the cost of capital is higher. And of course, there's some increasing returns to scale in a home in insulation. It costs less per unit in a bigger house. So they're very important distributional issues around the access to the new ways of doing things and the cost of capital associated with them, the increasing returns associated with them, which have to be directly managed. For example, if you want to invest in insulating your home, then the local authority, the energy company, banks, could all, builders, you've got a number of elements that need to get together, and governments can play a very important role in helping organize that and helping to do it at scale, which will bring costs down. The final thing is the job dislocation. Some jobs will run down, particularly the job in coal mines, for example. Now, the important thing then is to invest in people and places. Try to create new opportunities by investing in people. Try to create new opportunities in towns. In the old manufacturing coal mining areas in the UK, which were relatively prosperous in the 19th century, there were, for example, a lot of good universities that sprung up that are still good. Now, that's the example in my own country, but you can help promote new activity around those sorts of areas. You can build in different kinds of infrastructures. It's going to be investing in people and places, because both are important. The people are the people who've been, as it were, suffering the dislocation, and the places because some of that will be concentrated, and you want to try to give the whole place a good lift. So those are the three areas, I think, around the just transition. But let's be very clear, because it's a difficult problem, does not mean we should go slowly. This decade is absolutely decisive. Because it's a big problem means that we have to focus very hard and get it right, but not to slow down.
Thank you very much, Nick, who mainly addressed this just element of transition from the public policy perspective. But let's also hear from the private sector. Daniel, my question to you is Standard Chartered has released its own white paper on transition finance. I believe Standard Chartered is one of the very early adopter of a framework for transition finance, including a taxonomy, which you use internally. Can you elaborate a little bit more on this white paper you developed internally and how Standard Chartered is positioning itself to support climate transition?
Thank you very much, and it's a real honor to be part of a distinguished panel talking about such a critical subject. Let me start just by framing our overall approach to the climate transition. We have committed to reaching net zero carbon emissions from our own operations by 2025, and we also have committed to achieve net zero from our financing by 2050, i.e. the impact, the emissions associated with the lending and banking activity that we provide through our clients. We set out our approach on net zero in a white paper which builds on the global standards such as the SBTI, NZBA and PCAF and aligns to the IEA net zero scenario. And we put out 2030 targets for oil and gas, power, mining and metals last year. And this is building on top of our previous prohibition on financing any new or expanding coal-fired power plants. And we explained that all our legacy coal exposure would be finished in developed markets and emerging markets by 2032. But we really see this transition as very much a shared challenge. It's not enough for banks just to get out these sectors. We absolutely need to be part of the solution in helping rewire effectively both finance, but also rewiring how many industries, especially the hard to abate sectors, really can decarbonize. And there are many obstacles on this road to net zero. Last year, we interviewed 250 companies about their net zero goals in our Zeronomics report. And we found three critical impediments to net zero: a lack of urgency, a finance shortfall, and a need for clear standards. So to help tackle these challenges, first of all, we have committed to mobilize $300 billion in green and transition finance focused on Asia, Africa, and the Middle East by 2030. We've set up one of the world's leading renewable teams, and we have a dedicated team of sustainable finance experts working on the ground in places like China, Hong Kong, Asia, Africa, as well as Europe and the US. And that team is doing transactions such as, a 270 million green loan for Goldwind, a leading Chinese wind power company, or the 1.2 billion sustainability linked loan with KPIs for greenhouse gas emissions that we did for H&H recently. But on top of that, we have built this dedicated group of transition finance bankers to really work with the hard to abate industries to accelerate their transition, coming with expertise around hydrogen, CCS, and nature-based solutions. I think Madame Crystalline talked earlier around the understandable concerns that when you talk about transition, some people think it's transition washing or greenwashing. And that's why we put out our transition finance framework. It's on our website. And it basically sets out two things. One, the type of activity that is allowed under our transition taxonomy, which aligns to the IEA net zero scenario, that the type of activities, things like hydrogen, CCS, and others, that will mean that we can transition. And secondly, that the companies and institutions that we provide that transition finance have a clear transition plan. And we hope this dual control will really help support the growth of transition finance as an asset class, which, as you said, Dr. Marjon, at the beginning, I think is absolutely critical to help the planet transition going forward. We recently closed 2 transactions, decarbonizing a cement factory in the Middle East and the import of key technology to help stop flaring in an African country focused on oil and gas.
Thank you very much, Daniel. I know you're expanding your team rapidly. Your team in Hong Kong is actually recruiting a lot of people for transition finance. That's good news. Now, my second question to you is that Standard Chartered is deploying a lot of resources in emerging markets. I know you have operations in 60 emerging market countries and doing a lot of green investment there. And also as a member of the Green Investment Principle for the Belt and Road, how do you see the role of Standard Chartered in financing emerging market green projects? Can we do better?
We can definitely do better. And I think we are putting a lot of focus on it. I mean, you talk about the team growing. To give you a sense of this, I started sustainable finance at Standard Chartered with an intern. We now have a team of 50 people just focused on doing this and are scaling further. And we truly believe that we need to move the focus and the growth that we've seen in green finance to democratize that and provide that to low-income countries as well. Nick Stern talked about the risks around dislocation within countries from the transition. This is even more true, I think, across countries. We put out a report earlier this year called Just in Time, which shows that there is a $93.8 trillion financing gap for transitioning emerging markets by the middle of this century. It's a big number. There are lots of big numbers out there. What's critical about this report, though, is that we estimate that if the emerging markets themselves have to finance all of this on their own, it will actually leave their population $79 trillion worse off. By contrast, if the developed markets could raise this 95 trillion that will support the emerging markets transition, actually the emerging markets households will then be $68 trillion better off. But actually, crucially, the world GDP will be 3.9 trillion better off as well. In short, if the world will be better off if we share the burden around this transition much more evenly and fairly across the world. We talked about just transition, and I think this is absolutely critical to it. We need to talk about financing these flows as well. And that's why we're very proud at Standard Chartered that over 70% of our sustainable finance assets, which have been verified by a third party, focus on low-income countries. And we also want to be part of the solution. So we are the co-chair of the Green Investment Principles working group on financial innovation. And I think innovation is absolutely critical in this space to drive and catalyze more flows. And we're also part of the GFANZ, the Global Financial Alliance for Net Zero, work on mobilization to low-income countries. Two things we've talked about already, and I just want to re-emphasize them. First is the use of blended finance. We've done over $15 billion worth of blended finance transactions in recent years, whether that has been working with the ADB to support a solar plant in Vietnam, or working with the Republic of Angola to put in place clean water that will provide, for the first time, clean water access for 2 million people, working with the World Bank and others. Blended finance has to be a key tool in the toolbox in terms of how we move at pace in the space. The other one is carbon markets. We see a huge opportunity for a reputable, well-regulated, credible markets, increasing the flow of capital into low-income countries. Many are already moving that. We've heard about the work that Indonesia is doing and others. We have been one of the first investors into Climate Impact X, the first voluntary carbon market based out of Singapore, with support from SGX, DBS and Temasek as well. But we're also embedding this into the very transactions that we do. The first time that we did the world's first transition bond working with Etihad, we put in place KPIs that if they miss their emissions targets, they have to go and buy carbon credits to make up for the difference. And equally, when we did a $3.2 billion financing for Barings Private Equity Asia, that included KPIs, again, where if they're missed, we can move to using carbon credits to compensate the difference. I think critically, what I would really just say is that where matters almost as much, if not more, as how much. While first impact report on sustainable finance showed that by financing the same size solar park in India versus, say, the one in France, you will remove 7 times the amount of emissions from the grid by focusing on the one in India. And so as we strive to move at pace to decarbonize and achieve the SDGs, I think the finance community as a whole needs to really be putting a premium on driving finance to where it matters most, not just celebrating another record high in green finance.
Thank you, Daniel. I think many of the issues you're talking about addressing developing country, emerging markets, sustainable finance needs are very much a focus of this year's G20 Sustainable Finance Working Group as well. As our Indonesian colleague been saying that this year, the working group has focused on transition finance framework, but also a second major topic is to enhance the accessibility and affordability of sustainable finance for emerging markets. And we are doing some preliminary assessments on why money is not flowing enough to emerging markets. I think a lot of issues, including the lack of standards for labeling green projects, lack of ESG information, lack of the right products, and lack of capacity, and lack of blended finance, including MDBs, de-risking facility, and so on. I think in many of these areas, experience from private sector, including from your bank, it could be very helpful. Now, let me move on to question with Paulina. in the running up to net zero, both governments and private sector need to play a role. For example, the G20 Sustainable Finance Working Group is now developing a transition finance framework, and Europe is playing a key role in contributing to the framework. What is your view on such a policy framework, and what's your expectation for its role in guiding the transition finance work?
Thank you very much, Dr. Ma, and good morning, good afternoon, and thank you also for the invitation to this very interesting and I think very topical conference. I think a lot has been said already, so I will be brief, but just a couple of reflections from an EU perspective on your question. I think I would start by saying that the good news is that in the EU we saw already a couple of years ago that this massive challenge was coming, that we really need to finance the green transition. And we also saw that public finance, of course, would not be enough, so that we needed a very big contribution also from the private sector. Now, I think if that's the good news, the less good news or even the bad news is that this now has to be done really quickly. And of course, with the Russian war in Ukraine ongoing, we see that we need to even faster way than we maybe thought a couple of months or years ago, we would need to do this transition towards renewables even faster. So that's why I think this is getting kind of more and more important and more topical by the day. I think, as many have alluded to also, there is a massive issue around the a just and inclusive transition. And we see that, of course, also very much now with the increased energy prices. So that's something I think we need to be very mindful of also when developing our different policies. I think for us, the one thing which is really important here, that's by the way also why I think this is a very, very, very useful panel with such a wide range of speakers from various jurisdictions, that we really need a lot of international cooperation in this space. And that's why, of course, we very much welcome the G20 work on this issue. And by the way, I want to commend you also for co-chairing the Sustainable Finance Working Group on the EU side. We have been very active in this, also in development of the roadmap. And we, of course, are continuing to following this work very, very closely. I think what we need to aim for at an international level, and I've said this in many panels already, so I'm repeating myself, but I'll do that, is that we need what we often refer to as a bit of a global baseline. Of course, recognizing the fact that the regions come from different starting points, come from different challenges, but we need this global baseline, this interoperability, if you wish, between the various regional frameworks. And I think that is the way that we need to go about this issue. And very much in that spirit, I would have thought, or we would have thought, that the framework that will come out of the G20 process will be precisely that you kind of try to put and fix together a rather ambitious baseline, but that, of course, recognizing the fact that the different regions will approach things in slightly different ways, have slightly different starting points, different circumstances. And I think that is important, that we kind of find this, in a way, the right balance between principles that are high level enough to be able to be that baseline for everyone, but at the same time granular enough so they actually are meaningful and actually can be implemented in a good way. So now, in terms of kind of general policy framework, the way we have gone about this in the European Union is we have three building blocks. One being sustainability reporting and disclosures, and I'm sure that Sue will speak much more about that also later on. The second building block is taxonomy, and I will get back to that, I think, in my second question. And then the third building block is the various green instruments, if you wish, green bonds and green labels. So that is, if you wish, a little bit the overall policy framework. Now, I think what's really important, notably the transition work, is also the entity-based transition plans. And that's why we are requiring our financial institutions to put in place themselves their transition plans. Because obviously, if you want to do the transition, if you want to be where you have to be by 2030, by 2050, you need to have rather granular targets to get to that space. Important also, I think, in link to those transition plans is the requirement to actually publish the transition plans. And that's something that we are foreseeing in our Corporate Sustainability Reporting Directive, which is the EU legal framework, which is hopefully very soon now being finalized by our co-legislators, and also the European Financial Reporting Advisory Group, EFRAG, is as we speak actually consulting a public consultation precisely on that, the requirements around the disclosure of individual transition plans. So all that I think is quite important. And now, and that would be my last point on this first question, and that is if we look at the EU policy framework, and I described the three main building blocks of it already, we are not only looking at what is green already, so to speak, in inverted commas, but also focusing very much on the transition phase. And I think this is very much also in line with the G20 work. We know where we are, we know where we need to go, but we also need to get there. And that is why our taxonomy is also explicitly kind of dealing with this transition phase, as you also already alluded to, Dr. Ma. I will stop there. Thank you.
Thank you, Paulina. You mentioned interoperability of sustainable finance standards. I think it's a very important subject which is being discussed in many international fora, including the G20. And one of the sort of application of this interoperability principle is for taxonomies. As you know and are involved, the IPSF created this taxonomy working group, which I co-chair with Marcel Park. And we came up with the first version of the common ground taxonomy. But that taxonomy is still focusing on pure green activities in the mitigation space. But we also know that the EU has included some transition activities already in EU taxonomy. If you take these transition activities out as a standalone piece, it looks like a transition taxonomy. Now, what we are interested in is there are different approaches in identifying transition activities. One could be a taxonomy-based approach, such as what the EU is doing. And the other one is suggested by other members of G20, including our Japanese colleagues, saying that they would like to use a principle-based approach, which essentially says that the activity that's consistent with the 2050 net zero target with some verification from external verifier will be considered as transition activity. Now, what's your view on these different approaches in identifying transition activities, pros and cons?
No, thank you very much. I mean, first of all, to say that I think there is one element here which is really important, which is to combat greenwashing. And that is what we, of course, see, I think, across the world, in the sense that more and more people are saying that they are very green, they're very sustainable, but there's, of course, also quite a lot of greenwashing going on. And the reason I'm mentioning that is that I think when we look at our policy tools, when we look at our policy toolbox, that's also something that we really have to bear in mind. And the international alignment, again, here is so important, because ideally what is considered green, or even what's considered transitional in one jurisdiction, should of course ideally be considered in a similar way also in another jurisdiction. So I think that's one important element. Another important element is the monitoring, and that's why I should have mentioned that earlier, actually, because I think it's very good to have these policy tools in place, but we also need to monitor how this is actually implemented in practice. We need to monitor to what extent finance is flowing into sustainable projects. So that's also something that we are working on. Now, on the various approaches here, and you mentioned that in the sense of taxonomy, which of course is something we've also been working on in the context of the International Platform Sustainable Finance, and you mentioned that, of course, there are different ways to go about it. And I think the way we have always looked at this issue from an EU perspective, from European Commission perspective, is that we need the private and public sector to work together. So the idea has never been to say that we only need a regulatory framework and then everything else will come by itself. It's really clear that we need to basically pull on all the levers we have, be it market-driven initiatives, be it a policy-driven regulatory framework. Now, it is true that what we have concluded is the best approach for Europe is a taxonomy-based approach. That's also because we need to regulate for 27, which means that for us, having an approach that's only based on, let's say, what the markets would do itself would probably not be sufficient, and would, I think, importantly, not be sufficiently fast. And that's why we believe that taxonomy framework is so useful, because it's a common grammar. It basically is a set of standards based on a solid methodology, that investors can use, that financial institutions can use, that market operators in general can use. It's a voluntary tool. I think that's important because it's basically something that we want should be used as a help, as a tool for those who so wish, when they want to gradually move their activities into a more sustainable place. And that's also, of course, as you mentioned already, that we have been looking at what is in a way already green, but also on kind of certain transitional activities that, subject to certain rather strict conditions, are included in the taxonomy. I think what's important here also is to bear in mind that the taxonomy is not a static instrument, because that's sometimes what is also argued in this context of whether taxonomies are useful or not. People say that, well, that is too static and that is too rigid, because of course we have a lot of technological developments going on. We see all the time that things need to be adjusted. But I think precisely that's something that we have built into our framework, because we have this general taxonomy framework, if you wish, but then the possibility to adjust and adapt and update, precisely to take into account also various technological developments. And also in this context, regular reviews to basically make sure that this framework is fit for purpose. So I think that, again, there can be different ways to go about it. I think the clear advantage with having a kind of regulatory framework of the kind that we have in Europe is also legal certainty. And that's something that companies and investors have been pointing out to us a lot, that, of course, you don't want rules that are overly prescriptive. You don't want rules that are overly complex, but it is really, really helpful to have this kind of general legal framework, legal certainty in terms of what rules apply. And I also think, and that's the other advantage, I think, with having this more kind of regulatory, in a way, to a certain extent, prescriptive framework, is that what if your market-based approaches are not enough? What if, you see that with time, and again, I've said we don't have a lot of time, that is actually not enough to move a sufficient amount of funding into the sustainable space, passing, of course, via also the transition. Then I think that is also another situation where it is helpful to have this kind of regulatory framework, because then it's also clear what you can do if a market-based approach is just not leading to a sufficiently fast result. So again, I think, there are different approaches to this, of course. I think, as always, one needs to take into account the various legal traditions, the various starting points from different jurisdictions. That brings me back, by the way, again to the issue of the international baseline. I think that's really, really important. And I think that's for the reason I mentioned, that the way we have decided to go about it in Europe is this kind of taxonomy-based approach. And that's, of course, something that we are also very happy and discuss with a lot of other jurisdictions, and are very happy to continue to do so. I will stop there. Thank you.
Thank you, Paulina. I also hear criticisms on so-called rigidity of the taxonomy approach. They're saying the taxonomy, which lists all the activities, is rigid in the sense that it does not allow new green or transition activities, and it's not dynamic. But I think this issue can be addressed fairly easily. For example, Daniel, you have your internal transition taxonomy, which may have, let's say, 30 activities considered as transitional. But you can certainly add one more line, that's 31, saying that other activities that can be consistent with Paris Agreement after certain verification. I think simply by combining the taxonomy approach and using the flexibility of principle approach, I think we can address this rigidity issue. But I think, Paulina, you're pointing out two key aspects of preventing green or transition wash, which are we need to have a set of approach to identify the right activities, whether they are green or transitional, and we need to have reporting, disclosure, monitoring, and so on. That's the second, key aspect of the prevention of a transition wash. Now that brings me to Sue Lloyd from ISSB. As we know, end of last year, IFIS launched the International Sustainability Standard Board with a G20 endorsement. And apart from your, I guess, a lot of efforts in setting up the management team and the offices, I think ISSB has been done a lot of work already, including by issuing a draft sustainable disclosure standard a few months ago for public consultation. Can you elaborate a bit more on the main contents of the draft standard?
Sure, and thank you, Marjon. Thank you very much for inviting me to this really important panel, and I'm really enjoying the discussion so far. And let me just share Emmanuel's apologies. He would have loved to have been here today, but I have a distinct competitive advantage over him this morning because I have my voice, which he does not today. So let me touch on what's in our proposals, which we published at the end of March. So we actually published two sets of proposals at the end of March. One is a set of proposals requiring disclosures on all of a company's significant sustainability-related risks and opportunities that are important to understanding the value of a company's shares and debt from an investor's perspective. So a generic standard, which would include things like just transition, for example. But what I'll talk about mainly today is our specific set of proposals on climate disclosures, which are out for comment at the moment. And I think the first thing to note about the proposals that we've put out is that they build very heavily on the TCFD recommendations. So we ask for information to be provided about the governance, strategy and risk management around climate-related risks and opportunities, and also the metrics and targets that a company is using to measure and manage its management and progress in managing climate-related risks and opportunities. We ask for information on both physical risks, transition risks, and also climate-related opportunities, because they're all really important pieces of information for investors to understand enterprise value. We ask for cross-industry information. So we ask for information about, for example, companies' greenhouse gas emissions, Scope 1, Scope 2, and Scope 3. And we also ask for industry-based requirements set out with the specific climate metrics that have been identified as being particularly relevant for investors to understand climate-related risks and opportunities in particular industries. And maybe I'll just comment on a couple of specific proposals I think that are interesting in the document and which might relate to some of the areas that we're talking about today. So the first is some enhancements that we've made over and above the TCFD recommendations. And one of the key areas where we've really tried to increase the specificity is around the resilience of a company's strategy to different climate scenarios. So we're asking companies to provide information about how their strategy would need to adjust and what their plans would be in different climate scenarios to enable investors to understand the planning processes of businesses and also the risks and opportunities in front of them. We also ask for specific information on a company's carbon emissions targets, not just what their targets are, but how they plan to achieve those targets, and specific information, for example, on whether they are actually planning to reduce their carbon emissions or whether they're using carbon offsets, really to give as much transparency as possible for investors to really make informed investment decisions. And a key area of the proposals that we have out for comment at the moment are some new proposed disclosures on financed and facilitated emissions to enable us all to get some more clarity in terms of transition risk for the banks and insurance companies themselves, in terms of the types of business they're doing and where their carbon exposures are. So that's out for comment until the end of July.
Thank you, Sue. As we discussed today extensively, transition finance also requires transparency, but the transition finance requires more forward-looking information. For example, a company needs to produce and disclose information on its transition plan, which really span from today to 25 or 30 years later. ISSB certainly is working on a TCFD-based standard for this year, but I think in the longer term, some consideration on how to accommodate transition finance-related disclosure requirement might be necessary. Is there any thinking along that line within the ISSB?
Well, actually, in the proposals that we've got out for comment at the moment, there's quite a lot on transition planning, and it's really designed to enable investors to get this information in their hands that we've all been talking about on the panel so far, to really increase transparency and also global comparability, because our dream is that our standards would be used to meet investor needs in jurisdictions around the world. So just to touch on what we've actually got already in the document on the transition front. So we ask for information to enable investors to understand the company's ability to adapt its planning and its business model and operations for transition risks. And so we ask for information about their strategy for addressing significant climate-related risks and opportunities, and how that's being built into their strategy and decision making, including the transition planning. And so we actually ask for information on a short, medium, and long-term basis to explain what a company's doing to plan for changes, potential changes to its business model, its resource allocation, and also its ability to access finance in order to address potential changes in the business model as a result of climate transition risk. So we actually are asking for this in the current proposals that are out for comment. And we're also asking specifically for information on what companies are doing to directly address adaptation and mitigation effects, what they're doing themselves in their operations, and what they're doing indirectly as well in terms of what they're planning to do in relation to their supply chains to manage transition risks. How are they going to have to adjust their supply chains, for example, to deal with transition risks? And so we're really already looking for this forward-looking information about transition planning, and also very specifically on carbon emission targets and the plan for the business model going forward to try to get, GHG emissions down, scope 1, scope 2, and scope 3. And we've got a lot of requests for information there to really enable investors to assess how credible they think these transition plans are, how credible are these carbon emission plans, and do investors agree with them? There's different approaches to dealing with carbon emission reduction, direct, actual carbon reduction, but carbon offsets. And there's different opinions on what's good and bad in that space. And we're trying to be as neutral as possible, but to give as much information as possible to enable investors to really decide who they believe has got good transition plans and where's a good place to really put money to affect change if that's important to you in making your financing decisions. And so we're really trying to shed light on this really important area, I think, which would really, I think, Mahjong, going back to your first point in terms of the objectives of getting, identifying what transition planning is actually going on by reporting on what a company's plans are. So I think hopefully really consistent with this G20 work that you're doing.
Thank you very much. So it's great to hear that ISSB are already incorporating some transition finance related disclosure consideration. And I'll come back to you, Sue, in the second round, not immediately, on the question of how to apply the ISSB standards to SMEs, which are very fearful that standards could be too costly, too cumbersome, and so on. We'll come back to that later. Now, let me move on to Karen from Deutsche Bank. Essentially the same question I was asking Daniel. Can you elaborate the climate goal or net zero commitment made by Deutsche Bank? What are the key components of that?
Thank you. And first, thank you for the invitation on this fantastic panel. Let me just start with the starting point for us, which is that we do have all of these sustainability plans. And I'll talk about them in a second, but I want to also make sure everyone understands that we view them also as core to the commercial success of Deutsche Bank going forward. So we are starting from an assumption that this ESG concept is going to permeate every aspect of the financial services industry. So for any bank to be competitive globally, they have to be an expert bank in terms of ESG. We are, of course, founding members of the Net Zero Banking Alliance. We are signatories to almost all the global conventions on sustainability that exist out there. In 2020, we announced our goal to reach 200 billion euros of sustainable financing by the year 2025. Last year, we brought that back from 2025 to 2023. And I can tell you here with quite a bit of confidence that we are probably going to meet that goal by the end of this year. So that's been our journey. What does this mean in practical terms, in terms of how a bank organizes itself to execute this kind of business model? It has let me break it down into three different sections. First is controls and regulatory work. So regulatory is coming, and but the control part we had to build ahead of time. So this is about having our own ESG taxonomy, understanding that there will not be universal standards for a while, although a very loud shout out to ISSB and SASB and others who have contributed greatly to this cause. So we decided we needed to build our own taxonomy, and we have done that. And it's very closely tied to the EU taxonomy. We had to add the social aspect elements into that a long time ago, and it continues to evolve as the EU taxonomy evolves, as we learn more. So that's the control part. Regulatory part is coming. So ECB just asked all European banks to start issuing reports on climate risk stress testing. We've just started that process. It has shed a lot of light on this part of the business, what we need to do, where the issues are, and how to address them. The second area is on our portfolio, which is to say, what is the carbon footprint of our portfolio? Where's most of our carbon footprint with respect to, let's say, scope 3 coming from? And then the third, and perhaps very, very important, is the client engagement, or you can call it client advisory. This is, key to the success of this entire ESG movement, that the banks build this capacity and have this 2-3 layers deeper understanding than what the financial services industry currently knows about sustainability and things of that nature. And our colleague from IFC will certainly be able to speak to that. So on top of that, you add the Asia or the emerging market angle. So our very strong view is that the concept of copying and pasting rules from Europe and North America into Asia is not going to work. That doesn't mean we should dilute those rules. What that does mean is that you need some people who are experts in sustainability as well as regional norms and standards to be able to decipher which metric, what kind of KPI makes sense in which market. I can tell you that it could be a KPI that I would say, yeah, that this could be reliable out of Indonesia, but if it came out of another country, I would think it would not be as reliable, right? That understanding is very, very critical to use the standards being set up by ISSB and EU and others, and apply them in a smart, educated manner to the realities that are on the ground in Asia. The portfolio bit, now let me just go to the Asia part again. So what we did was we set up an ESG Center of Excellence here in Asia, not in Frankfurt, not in London, not in New York. We set it up here in Singapore in partnership with MAS. And the reason for that is because we wanted to have our ESG firepower here. This is where the cutting edge of ESG is going to be. And why do I say that? I say that because the vast amount of global FDI continues to pour into Asia. This is where the future industries are being built. This is where the future distribution networks are being built. So our view is, look, if we don't do enough to make sure that the future growth of Asia is going to be sustainable in reality, not just on paper, not just in talk, but in reality. If Asia's growth is not sustainable, no amount of recycling in Europe is going to save the earth, right? So it's an important responsibility for all of us to focus here. And what we have found over the last 2 years of executing the strategy is that there's a lot happening in Asia, and we're actually increasingly doing transactions in Asia which are setting global standards in the industries. So we did, for example, the first green hedge in the world out of Asia, which has its own hedge framework, like a bond framework. We did the first SDG Panda bond We did the first transaction in the data center industry, which uses power usage efficiency as a price-linked KPI. Massive transactions, 1.5 billion, 3 billion. These are deals happening out of Asia. And we think that this will happen more and more. And this is where, as I mentioned to you earlier before we started, the role that the Chinese economy plays in the establishment and growth of the ESG movement is going to be very, very critical. Because if we can bridge the gaps, whatever gaps remain between the Chinese green finance rules and international standards, that will make it a lot easier for people to move in this direction. Let me stop here.
Thank you, Karen. I totally agree with you that the banks need to develop a capacity to engage clients, providing advisory services on net zero transition. I think a lot of clients, they don't know how to do it. They know they should do it, but they don't know how to do it. And a lot of banks internally still doesn't have enough capacity. I think that's why people like that is experiencing a lot of wage inflation for the moment. And I was joking with the big 4 accounting firms in China. They are all setting up their advisory teams for advising clients on net zero transition. And I said to them, you need to produce a talent pool of 100,000 people, consultants to advise on carbon neutrality strategy for Chinese corporates. So it's massive demand there. But let me come back to the second question, Cameron, for you, which is the carbon accounting. You said financial institutions like Deutsche Bank is working on net zero for own operation, which is relatively easy. You are sort of achieving net zero for your building and travel and so on. But when you come to the finance emission, which include the carbon emission out of your lending and investment operation, it's much more complicated. It requires carbon accounting of scope 3 emission. How do you handle that, which is really a challenge in a lot of developing countries, FI?
Yeah, thank you. Very important question. And, I have good news and I have bad news. Let me start with the bad news. Bad news is that we can now see where the carbon footprint is coming from. The good news for us was that it wasn't thousands and thousands of clients that are associated with a vast majority or the bulk of our carbon footprint. So I would say 80% of the total carbon footprint comes from roughly about 100 companies around the world. So then the question becomes, okay, what do you do? Do you just show up as a bank and say, look, dear client, you have 3 months because we have this new policy. You either shape up or we're out. That's not banking. That's not any kind of service advisory, right? So what we are doing is we are actually going through the whole process of saying who these clients are, what industry are they in, what their issues are, what options exist for them, and then go in front of them and start the dialogue. Now, we're not assuming that 100% of these clients will convert to sustainable practices on a reasonable timeline, but we do believe that many of them are already looking to find ways to accomplish what the world wants them to do. Some of these are in what are called hard-to-abate industries, and hence this transition finance issue becomes very, very relevant for us. Now, here I would say that the key to why there has not been enough money in transition finance, people say all the time, how come there are not that many transition bonds and so many green bonds compared to, for example, transition bonds? Well, one of the key issues is that saying you will transition is easy, but demonstrating and substantiating a move towards sustainability requires very serious effort. So what does that transition plan look like? How specific is it? Is it approved by the board? Does it deal with transfer of cash flows towards cleaner industries and cleaner businesses? Is there a tracking system for the transition? All of these things matter. And this is why, as you rightly point out, this work is going to require quite a bit of heavy lifting. And our strategy is to make sure that we do this through an evidence-based, data-driven approach to ESG. We believe that is the best answer to the risk of greenwashing. You need to be very specific about the commitments you are making. That's certainly our advice to our clients and to ourselves. Be specific about what you're saying you will do. Use the right metric to make that commitment, and then better have data ready to show that you are actually doing it, rather than just make statements and then try to answer the incoming questions with, rhetoric and so on. The other part that is, I think, kind of important to understand are the lessons, or what can you do to execute this better. And so let me quickly list 3 items that I say this not just as Deutsche Bank, but I think most banks have experienced the same thing as we try to figure out how to do sustainable financing. First is related to Asia. You hear quite often the numbers which say, well, this is the number for sustainable finance in Europe, this is the one for North America, and then here's one for Asia. And most of them come through the league table type of data. What I would encourage everyone to do is to not focus on where the capital was raised, but rather where the capital was deployed. And I can tell you from our experience, we're watching companies raising billions of dollars in Europe, and then we see that most of that capital is actually coming to Asia. So the sustainability of that investment that an investor made in that company's bond or any other instrument really depends upon how this company is operating in Asia. The second key point, the process as well as the culture to say no. Very important for large financial institutions to be able to figure out how do you say no when mostly to your own staff. When they come to you and say, can we do this as a sustainable financing? And you have to be able to say, if the answer is no, you have to be able to say no, and you need to say it early in the process so the client is not led astray into thinking a transaction can be done as a sustainable finance transaction, only to be told at the end because some committee ruled it down. And finally, very, very important area is consistency in application of standards. So most financial institutions have experts who can develop very nice frameworks and taxonomies. Question is, how well are those standards being executed across the world? And are they being executed at different shades of gray? Very, very important issue for us. We have spent a lot of time on that. We have a centralized validation team that sits in Frankfurt. They are agnostic to revenues, agnostic to relationships, agnostic to profitability. Their only job is to look at our own taxonomy and say, does this deal adhere to the standards we have publicly stated? And that's it. And that's really helped us to build the quality of our ESG work. And that's why I'm very proud, not just of the deals we have done. We did 138 transactions, ESG transactions in APAC in 2021. With a dollar value of 51 billion US, which is massive if you compare it to 2020 numbers. But what I'm most proud of is 21 ESG awards that we got in APAC for APAC transaction deals sourced and closed in APAC. So I think if you can keep the quality up, you get the volume. And when you get the volume, you gotta then be very, very proactive in terms of forward-looking approaches and trying to understand what are the new challenges coming our way. Because this is a new industry. Everything here is new. We're all learning. And I think that's why my view on the standards, if they have come a little bit late, it's probably not as bad a thing as people make it out to be.
Thank you very much, Karen. I heard you saying that 100 big clients of Deutsche Bank contribute to 80% of your finance emission, which mean that the other maybe few million clients contribute 20%, but the work they do to account their carbon emission, I think it's going to be much more difficult relative to the size and ability compared with the larger companies. I think that brings back to the earlier question I wanted to ask Sue regarding reporting standards, how to cope with the problems facing SMEs and so on. We'll come back to that in a short while. Now, let me move on to Vivek from IFC. The focus of your work is certainly financing emerging market green projects. There are lots of private capital in the marketplace, especially in OECD countries, but still relatively little going to emerging markets. Now, what we can do from MDB IFC perspective to leverage these private sector money and channel them more effectively towards greening the emerging market economies?
Sure. Thank you so much, Dr. Marjun, and a big thank you to you all for having me here. But before I get into that, I just wanted to put the elephant in the room when it comes to transition finance, which is not being talked about today. And that is fundamentally, it's going to be very different than what we've done over the past 20 years in the energy transition. The energy transition was essentially, we were building out green fields, solar, wind, and some hydro. And it was, I'm not saying easy, but it was relatively easy. Now comes the difficult part when we have to start decommissioning coal. But when it comes to transition finance in the heavy sectors, which is where we've seen very little activity, and to be honest, it's pretty superficial what we are seeing, is you're really going to be taking a brown company and making it green. And that requires a very different mindset. And we can have all the taxonomies in the world, but decarbonizing a steel mill in India will take a lot of different thinking than decarbonizing a steel mill in Mexico or Indonesia. And therefore, what we need is very clear and specific plans company by company. And that's going to take a lot of time and effort. And that's really where we as MDBs need to be playing a much larger role than we are today. So that's one part of it. The second part of it is everyone's carbon emissions are going to go up as FIs if we are going to decarbonize the economy. If you're going to start on this decarbonization pathway or transition pathway, it means you're going to take on an asset which has a pretty high carbon footprint but hopefully over time it'll come down. And we can have all the KPIs in the world, but what we need to be prepared for is what if the company does not adhere to its KPIs? Are we going to call a default and try and get our money back? I mean, these are some real questions that we've been posing to our clients. And I was talking to a client of ours, a large steel company, and they said, okay, we want to do the right thing. We want to do everything. But hey, what if steel prices fall by 40%? Should I use my cash flow to pay my employees and keep my furnaces running? Or should I continue on my pathway to decarbonization? So I think where MDBs have to be playing a much bigger role is getting this thinking across to governments, getting this thinking across to clients and all other stakeholders. And when I say governments, I just don't mean governments in which we operate, but talking to the developed countries and having them understand what it's going to take is going to be crucially important because they are our largest shareholders at the end of the day. The second part really is how do we take some of these technologies for decarbonization or transition into these markets? And there it's just very simple. It's a matter of capital. We need a lot more de-risking capital or blended finance, as we call it. I prefer to call it de-risking capital because that will do two things. One is hopefully some of the newer technologies need to be tried and tested, so there's technological risk. Secondly, some of these technologies are just expensive. But once I think they achieve scale, we're going to be able to drive down costs. And we saw that happen, quite clearly in the area of solar, where thanks to technological improvements and the growth in the market across the world, I think we managed to drive down panel costs, which was led by China. So I think we need a lot more blended finance for this to happen and to be able to demonstrate that this is something that can be done. The second is we really need to make sure, as you've said earlier, is a just and fair transition. And I think there's a lot of talk going on, but we really need to be able, and it's not easy because what will be the industries of tomorrow that we can scale up people in? And I'll just take a few minutes to talk about SMEs because I don't think the three financial institutions on this panel, which is two large global banks and IFC or MDBs, are in a position to decarbonize SMEs. We lend through intermediaries. And I can tell you, talking to some of the regional banks or some of the local banks, they are just telling us one thing. They're saying, we would love to do this, but A, we don't have the means. B, we need the technologies, we need the advisory services, as you said earlier. But very importantly, we need to be mindful is, are we putting a huge reporting or regulatory burden on them today? I think it needs to happen. It should happen, but we really need to give them time. Otherwise, what's going to happen is people will just shy away from doing this, and that will be a lost cause then. So I think for us, the 3-4 key issues are that a lot more blended finance is needed in this space. We need to be able to work with our partners in emerging markets so that the SMEs can be reached. Because I think, to be honest, getting in global capital to green SMEs is just not going to work. Therefore, you need to green the domestic financial sector, and then those banks are in a position to raise capital overseas. Third is we need patience, and we need to be clear on what is going to happen in the interim, and we need to be able to explain that to our stakeholders. And fourth is, I think we really need to work on getting synchronization of standards. And I'm not saying that to be perfectly synchronized, but we need that transparency so we can compare what's happening in one country, which has its own set of circumstances, to another country, which has a different set of circumstances.
Thank you, Vivek. As you mentioned, the de-risking topic, we've been discussing this a lot, including in the G20 working group. We know that many of the de-risking facilities are working quite well, including IFSC's operation in the past. And you have done the Chewy project back more than 10 years ago successfully in China. And also, innovative products that you launched together with Amundi and so on to mobilize private sector money. Now, what's preventing MDBs from operating on a much larger scale for these de-risking facilities? And what should we do?
So I think there are 2 or 3 things. One is a lot of the institutional capital that we're talking about is not going to be coming into emerging markets unless it's completely de-risked. And therefore, the amount of capital we need is going to be a lot more than what's available out there to de-risk, the de-risking capital. So what I think MDBs should be doing a lot more is actually working with domestic financial institutions, the domestic MFIs, the domestic microfinance companies, and de-risking them as well, because that capital stays in the country. A local banking capital. So what we really have to be doing at a much larger scale is how do we connect local taxpayer money, local pension money, and put that into climate. And initially, a pensioner sitting in Western Europe, I think would be concerned if his or her pension was being invested in emerging markets where the risks are a lot higher, or the perception of risks. So really working with domestic financial institutions and getting them to direct their capital, the pension money, the domestic savings into climate is going to be is really where we would like to be spending a lot more time and energy. That also takes away one very, very important risk, which is currency risk. And emerging market currencies, by and large, have gone in one direction. So ultimately, it's the taxpayer who's going to bear that burden. So how do we work on fine-tuning or attuning our domestic financial systems to come into climate and direct their capital to climate, I think is really where we have to be using our energies. And that's really what I would personally like to see happening over the next 5 to 10 years. It's going to be a journey, but we need to make a start. We've started it in some countries. It takes a lot of very heavy lifting to move the needle there. But that's where we need to leverage people like yourselves, Professor Stern, to be talking at forums to make this happen, using the NGFS to make it happen. So that's really, I think, the journey that we'd like to work with you all on. Thanks.
Thank you very much, Vivek. I think we have less than 10 minutes left, but I promise to try to do a second round. Now, let me just ask through this question on SMEs. disclosure. How do we, minimize the cost of SME disclosure, at the same time getting meaningful information in terms of carbon emission and so on?
The dream. So the first thing is that this is a really, really important question for us, and so something we really want feedback on during our consultation. Both, the ability of smaller companies to provide this information, but also emerging markets is really important as well. So I think the first thing for us is it's really important to gather facts about what's difficult to do, and also which information is really important for this decision making to make sure we've got the right set of information. But then moving on to sort of the practicalities of, how do we then deal with that? So already in our proposals, we've got somewhere with some of the quantitative proposals in there, we say if you can do this more complicated thing, then do this, and if you can't, do a simpler thing. So I think one of the things we'll do is look and see whether there's other opportunities to build in simpler options within the standard based on the feedback that we get. I think the other tool we've got to use, and we'll think hard about, is whether we should allow longer timelines for some companies than for others, to allow more time for them to prepare and more time for the market to develop techniques and technology, etc., to give them time to catch up. And I think the other thing that the foundation will be very interested in doing will be working with others to ensure that we are doing everything we can to support capacity building and understanding in the markets around the world, and also to brainstorm with others for technology and innovations which may help people in terms of gathering this information and providing it. But I think the first step is making sure we've got the right set of information, so that we're not asking people to provide information that isn't actually necessary for investment decisions given the type of company that we're looking at. And perhaps a bigger strategic question at some point for the board will be whether, in the same way that the IFRS accounting standards have got a book which is designed for more, listed companies, there's a separate small book of simpler requirements for unlisted companies, whether that type of strategy is something ultimately we need to look at as well, but something we're really interested in and very keen to try to address.
Thank you. So I actually see sort of three options emerging from your discussion to handle this SME stress on disclosure. One is to produce a simpler version of the standard instead of asking them to put out something a big multinational would do. And second one is giving them a little bit more time, what I would call sort of a grace period, so they can adapt over time. And the third one is technology you mentioned, but didn't elaborate. I think that's very important. We can borrow the concept of digital technology used in financial inclusion, which has drastically reduced the cost of smaller companies, individuals getting financial service in the past few years. But we should also be doing that for disclosure in green and transition finance going forward.
And I think it's really important because one of the things that we're asking for is scope 3 information from bigger companies as well. So if we can assist the smaller companies collecting information indirectly, it will help the bigger companies as well. So I think there's a lot in it for the entire system if we can get some of that to work.
Thank you. Now, we still have a few minutes. Let me actually open the floor to our panelists. I think you might have something in mind you want to say, react to other panelists and so on. Nick, please.
Thank you very much, and I thank you for the fellow panelists. I learned a lot from the discussion. The first thing is the awkwardness of the name taxonomy. It comes from biology. You are either fish or fowl, or a low level of specificity. You're a salmon or a duck. And that's not very helpful use of language in this context. What we're talking about is transition tracking standards. The transition is a move from place A to place B. We want to track it, and we want standards for tracking. The LSE, London School of Economics, has been very much involved in establishing the Transition Pathways Initiative, which most of you will know about. It's very much in that spirit. So taxonomy is an unfortunate use of language and has led to sort of silly discussions as to whether a gas is green or not. Well, it depends. It depends where it is in part of the big process and so on. It depends whether it's got carbon capture and storage. It's a transition that we're tracking. So if we can move away from the word taxonomy, I think it will make our analyses sharper and understand clearer. The second point is to echo what was said. Certainly, by Daniel Hanna, Vivek Patek, Kamran Khan, is the importance of money flowing to emerging market developing economies. Depending how you run the numbers, we have to increase investment in emerging market developing economies, excluding China, a couple of $1 trillion a year by 2030. That's roughly consistent with the kind of numbers that Daniel Hanna was describing. And at the moment, the people on this call are devoted to that. But if you look at the overall quantities, they're really not there. Those flows are nowhere near big enough. And it's going to be enormously important to build our blended finance, our concessionary finance, which will be so important, the natural capital and driving past coal, to build what the MDBs can do up very strongly in the next few years. We probably have to triple what MDBs can do in order for them to put on the sector on scale that we need to respond to these problems. So I think we have to speak clearly and loudly about scale and location. We have to invest much more. The numbers scream it at us. For that investment, we'll get a new form of growth, a much more attractive form of growth. It's not simply a cost to drive down emissions. It's actually investing in a new way of doing things. Just tremendous returns. Cities where you could move with trees, for example. Those are very high return, much more efficient economies. Resource efficiency goes up, productivity goes up. It's a tremendous story, but you have to invest a lot to get there, principally in Asia, and you need different sorts of finance for different parts of this story. So I think we have to speak up loudly and clearly on scale, location, and the role of blended finance in delivering it.
Thank you very much, Nick. I think we can have one more comment if anyone wants to raise hand. Daniel?
No, thank you very much. And I have to say, this was an invigorating conversation. And if anything gives me hope that we can tackle the big challenges around this space, it is just listening to the variety of different voices all thinking about what the potential solutions are. If I may, I wanted to build just on Nick Stern's comments, which is, I think it's really important that we now start moving to country-level pathways as well. Because I think to Vivek's point around domestic resource mobilization, which I think is a really powerful tool and there's a lot more that we can do there, that will work for some countries, not others. If you take China, for example, we estimate that there's a $35 trillion financing gap. That's probably half of all markets across Asia, Africa, and the Middle East. But China has a very sophisticated, deep financial market, is working on a number of different innovations and policy tools such as carbon markets and other things. And I think it's pretty clear that domestic resource mobilization with some help, China will get there. If you look at other emerging markets, particularly let's take Africa, where Africa has 40% of the world's solar potential, it's leveraging less than 1% of its wind potential. And if you look at the fiscal constraints that it has at the moment and the issues there, I think we then need to think about, one, what is the appropriate country pathway, but how do we mobilize at scale? And there I absolutely agree with Nick. We need to be thinking about what tools are really powerful in blended finance and others to catalyze others to come into this space. So I think the one thing I would build is this importance of being very country specific as we go forward in these terms, as well as thinking at the transactional level and at the thematic sector level as well.
Thank you very much, Daniel. I think we are coming to the end of this session. Now we see actually only a snapshot of the intensive discussions on green sustainable finance and in particular transition finance from the conversation we just had. And just to sort of summarize in a few words, I think most of the discussion, which seem to be like a random covering so many different projects, topics, but they are actually fitting to the framework which we described earlier. We needed some approach to identify transition activities, whether it's a taxonomy or principle-based approach. We need to make sure that the process of transition is transparent so we can prevent greenwashing. And we need a lot of efforts from financial institutions to produce the right products. And internally, financial institutions need to have capacity to deliver the net zero commitment, helping clients to plan net zero commitments and implementation. And we need public policies to support, which could include instruments such as carbon tax, emission trading system, and it could be regulation in certain sectors, just like Nick said, It could be in the vehicle sector, particular policies could incentivize green activities. So I think we actually covered many elements that goes into a framework, which will be published the later part of this year by the G20, but they enrich the discussion with real examples and contents. So that concludes our session for this roundtable. Let me thank once again our distinguished panelists for their great insight and contribution. And I certainly learned a great deal from the session, and I hope our audience feel the same. We're now going to have a break. I think only 15 minutes break. The next session of the Green Swan Conference will resume at 1 p.m. Central European Time. Thank you very much. Thank you. Bye. Have a good day.